I published a new post earlier today, November 29, 2025, discussing my trades. Over the past few days, a link to my blog post can be found in my profile section here at YouTube. I've been publishing those posts starting in October 2008. The Vanderbilt football team, with a 9-2 record, which I will characterize as unique without fear of being contradicted by anyone, will be playing Tennessee at Knoxville, where over 100,000 persons in an ocean of orange will not be reacting favorably to them. My father started taking me to Vanderbilt football games in the 1950s. Tennessee is currently planning to expand the capacity of their football stadium since it is not large enough at over 101,000 capacity to seat their fan base who want to attend the game. Stock investors remain in a confident mood about future earnings and the U.S. economy, but I have noted there is an ongoing rotation into dividend-paying stocks with yields greater than 4%, with the S&P 500 average dividend yield closing yesterday at 1.15%, far below the long-term inflation rates predicted and the break-even inflation rates for the 5, 10, 20, and 30-year tips. The 1.16% dividend yield is a historical low number. At a 1.6% rate, it takes about 43.7 years for money to double without any adjustments for taxes paid on the dividends and inflation, which will be higher than the dividend yield. The percentage growth rate for dividend payers has also slowed down in the aggregate over the past several years. When paying up for revenue and earnings growth, where PE multiples now using trailing 12-month GAAP EPS are generally in the 40 to 100 range, can result in severe valuation resets whenever a report or reports throw cold water on the future growth projections embedded in those kind of high multiples. Using the past 12 months of earnings, the PE on the S&P 500 was at 25.25. Having estimated and using the estimated 12-month non-GAAP EPS earnings over the next 12 months, which excludes a number of items that negatively impact GAAP earnings and are generally highly optimistic to boot. The PE multiple is 22.09. I'm taking that data from the Wall Street Journal's market data page for stocks. I'm increasing my allocation to dividend-paying stocks and to preferred stocks to replace some of the income that will be lost when reinvesting the proceeds from Treasury bills previously purchased at auction that mature and other short-term maturities as well. The 3-month Treasury bill was close to 5.25% in June 2024 and is now close to 3.75%. I would expect it to come down before starting to go back up, which I do not anticipate will happen in 2026. The decline is due to the Fed cutting the federal funds rate that started with a 50 basis point cut in September 2024 and several after that. Prior to cutting the FF rate, the range was 5.25 to 5.5%, and it's likely to be at 3.5 to 3.75 after the Fed meeting in early December, when investors anticipate that a 25 basis point cut will happen. I calculated in today's post that I increased my dividend income by $163.61 last week based on the current common stock dividend rates. All of the preferred stock dividends from preferred stocks that I purchased are at fixed rates. While that does not sound like much, continuing at that pace for 52 weeks would add $8,507 in dividend income over existing levels at the end of that 52-week period. I'm going to add some dollars to purchasing BDC stocks, and we'll discuss buying a new one purchased yesterday in next week's post where my dividend yield is over 14%. And the usual caveat about buying stocks with dividend yields that high applies here. I disfavor BDC stocks now and consequently will only devote a tiny amount of capital to them, and that was after eliminating or significantly reducing my already small positions in them earlier this year. I eliminated several of them. A number of them were just tossed for whatever profit I could receive from selling the shares. Their net investment income is being pressured lower by floating rate loans that they have, and most of them have mostly floating rate loans, resetting at lower coupons due to the decline in short-term rates that started when the Fed started to reduce the federal funds rate in September 2024. The net investment income per share is also drifting down due to an increase in non-performing loans, which is happening without a recession in place. Possibly a bottom is forming in some of them. A lot of bad news is already baked into their share prices, and the dividend yields are high and would remain high compared to other stocks even after the anticipated dividend cuts, which I am now expecting due to the lower net investment income. And this is one sector of dividend paying stocks which has not shown any life last week and have been continued pressure down in price.